This happens when you have multiple buying or selling opportunities. You might have an uptrend like this one where you have two demand zones where you can trade with a buy setup, and you're not sure if you should buy this one or this one. If you think logically, it would make sense that trading the demand that's the lowest would be the safest option. But let's represent graphically on a simple way so we understand how two types of traders might see this in a completely different way. One trader will only consider the lowest demand available as the actual valid demand. The problem with this thinking is that the market can just fill the demand from above and push to the upside to continue the uptrend. If this happens, you miss the setup since the price doesn't get to your entry. So this trader must accept that he's going to miss a lot of setups where he was right about the direction of the market. This trader often considers the demand from above as a trap or inducement, so he waits for that demand to break down and later enter with a buy position on the lower demand. The other trader will buy the most recent demand, which oftentimes is usually the highest. He doesn't care about the risk of this demand being a trap. He usually trades as often as possible because he doesn't want to miss a potential setup. The problem stands that in most cases, the highest demand doesn't actually hold and is not a strong demand. This is the theory that most traders know, but the reality is that you can still win from levels that many consider as liquidity traps or inducements. So let's see how it's done. And the first thing we must know is how we got these two demand zones in the first place. Initially, if we're moving on the left of the chart, we're seeing a price action pattern of a downtrending market. Of course, the downtrend having the characteristics of lower highs on the swing levels, coupled with lower lows on the swing levels. So a very simple market structure fundamental so far. Then after breaking below the last low, forming the next lower low, from that certain low the market started having upside pressure. This pressure drags the market higher, breaking the previous lower high from the downtrend. This first break above the high indicates a potential reversal from a downtrend into an uptrend, this break being the market structure shift or bullish trend change. We can represent this even in a simpler way just to make sure things are properly understood by everyone. So far, this is what we've had, a downtrend price pattern. Then a break of the last high. This break is the trend change or structure shift from a downtrend into an uptrend. Well, now it's the important factor, because a break of the last high confirms that there might be a strong demand on the last low. Then the market usually pulls back to form the higher low, of course, in case the uptrend holds. And you will find that this pullback will probably end on a demand from where it continues the uptrend by breaking the past high. So what most would do in this case is to identify the demand and place a buy position on the demand, with the stop loss below the demand, and take profit above the last high. This is the most common plan, and this entire presentation is what actually happened on this market. Inside this price range, we got the reversal, and just like on the presentation, we identify the demand. That's the lower demand. But what about the second demand from above? So, after we got the first break above the high, the market held an uptrend pattern, breaking even more highs of the previous downtrend. This upper demand got formed from the last more significant pullback to the downside during the uptrend, right after it broke to the upside above the last high that confirmed this demand. But we can see that this demand invalidated to the downside, basically breaking down. So you would think that buying this demand would be a bad idea, and most would consider that it was probably a trap or an inducement. But the reality is that it really depends, what were you looking to target? So the difference is made on the take profit and stop loss levels. For example, if you would have bought right here, the stop loss below the demand, the take profit above the recent high. Well, in this case, it turned out to be a losing setup, because the market didn't went high enough to hit the take profit. It only got close, but then it hits the stop loss by these massive bearish candles. Others might still look to enter on this demand with the same stop loss placement, but with another take profit target. For example, targeting the swing highs from the downtrend. But this also doesn't end up well, ending with the same result of the market barely going up, then breaking below the demand. These two types of traders, after losing this setup, they consider this demand as a trap or as a fake demand. So the market can then pull into the actual valid demand, the one from below, where we can see that right when it filled, it quickly bounced to the upside on the exact next candle. And probably some of you watching my channel took opportunity of this setup with a buy position from this demand, which turned out to be a great setup. So because this demand from above did not work and has broken down, and the one from below has worked out well, many don't consider this one from above as valid. But here's the important part. This demand can be valid if it's used for the internal price action. And in order to see that internal price, we need to lower down in time frames the moment this market has hit this demand. This is the same market, same price, but presented on the 5 minutes time frame. And we see that right when the market has hit that demand from the 1 hour time frame, we got this bounce to the upside, having a bullish reaction followed with a small downside pullback. And if you pay close attention to the level where this pullback ended, you will see that it hit and bounced from a demand from this 5 minutes time frame, the demand being the last bearish candle before the market started the upside impulse. And we can test it out with a buy position. But the placements are what makes the difference between a losing setup and a winning one, because with this approach, now we're placing the stop loss below the demand from the lower time frame. And the first target for the take profit would be above the last lower high from this time frame, or above the next one, depending on the risk-reward ratio you would like to target. Just be careful of not having a too high or too low of a risk-reward ratio. Because, for example, above this high is the riskiest one since you're basically targeting the extreme level, the highest one. Since we're trading from the internal price action, it's safer to exit on an internal level rather than on an external one. The external swing high is the highest level. It's the only visible level if we zoom out on the 1-hour chart. And the levels from below are the internal lower highs from this 5 minutes time frame. Most would target the first internal high, but it's fine to also target the second one. When it becomes much more difficult is when you target above 1-to-3 ratio. That's when you must accept losing a lot of setups before getting a big winning setup. But for now, we keep it here, and we'll see if we get any other opportunity later. And a couple minutes later, it hits the take profit, meaning we broke above both internal levels from the previous highs, and after any break or close position, we always do a quick analysis of what the most recent price has done on the market structure. In this case, we got a push to the upside, followed with a pullback, then continuation into breaking the last internal high. Similar to what it has done before if we look at it. We got a push to the upside, pull back to the downside, then continuation in breaking the last internal high. This break above the high is a bullish break of structure, and that's a very similar price action to what it looks to be happening recently. If you're trading with the trend, you expect a similar thing to happen. So basically for this internal uptrend to continue, we need to see a pullback to the downside and a push to the upside that should break the last high. Now the question here is, where will this pullback end? So we can take opportunity with another potential setup. Around this candle should be the demand or support level, the same theory and structure like we had before, where the demand or support was the last bearish candle before the market gained bullish pressure. So we can repeat the same process, buy position from the demand, stop loss below the demand, and the first level for the take profit would be above the recent high. Or you might also target one of the previous highs from that downtrend. Around here, we have a similar risk-reward ratio to the last setup. Now, the only thing left is patience, because we're having this pullback to the downside right now. This pullback filled the demand and quickly pushed to the upside into the take profit, even higher than that. But from the highest level, it started pulling back down. And on the last two candles, we see how it's starting to bounce up. So could this be a higher low that bounces from a potential demand in order to form a higher high? There is a possibility just like it happened the last two times. So if we look on the left of this bounce, there might be a demand. So we try again with similar logic and similar entry and exit placements. But this time, it's closing a losing setup, breaking down the demand. Actually a very bearish price action, a lot of candles closing bearish one after another. And if we zoom out a bit, we're going to see how the market is right now testing this level. If you remember, this is the upper demand from the 1-hour time frame, a demand that we already know that it has broken to the downside. So if we come back into the 1-hour chart, we will see exactly how from this break of the upper demand, the market tried to continue this uptrend, but it failed to hold, and instead, we got a lower high formation. So later it breaks the upper demand again. This break actually happened for the market to fill the lower demand, the demand from below. Of course, as we saw in the first minutes of the video, this demand also giving a great setup that I'm sure some of you took this opportunity. Now let's do a quick recap as a conclusion. When we enter a market, and especially on higher time frame trends, let's say the 1 hour for example, and the market follows an uptrend, we know that during uptrends we look to buy from demand levels. What most would do is to consider buying the demand that's at the lowest level, because it looks to be safer, and they consider the demands or support levels from above as a trap or as a level that might not hold. And even if they are right, and this upper demand breaks down, the breakdown doesn't just happen with a straight down movement like we're seeing here, especially if we zoom into a lower time frame. For example, into the 5-minute time frame. This push to the downside will look more closer like this, where it has multiple lower highs and lower lows attached to it, so basically an internal downtrend, and usually the market won't just break this demand down instantly, even if this demand will break down later, In the short term, the market will probably still bounce from this demand, and enough of a bounce to break the last internal high, shifting this trend into a low time frame uptrend, or an internal uptrend as you might know it. And this trend change into an uptrend gives an opportunity for proper buying setups, but from the 5 minutes time frame in this case. We can do that by identifying a demand that was formed on the lower time frame. That's called an internal demand. And there is a pretty high probability that we can use this internal demand for a buying setup and get out with a win before the market might eventually break down this upper demand. The goal for the take profit targets are one of the previous internal highs, and to be safer, you might look to target either the first high or the second one, just to keep a decently high ratio while not putting yourself in a big risk of getting stopped out. If we were right, we should have a break of the last high. This break should hit the take profit target. And the thing is that this push to the upside might have created another internal demand that we can trade from. And if not, maybe the next one should have it, depends on the market conditions. But what it's best is to only look for one setup and then stop, because if you keep going and trading these internal demand levels, at some point we might get trapped in the actual breakdown of this upper demand from the 1 hour time frame, obviously losing the setup, just like it happened on the charts a few minutes ago. The point of this break of the upper demand is so the market can fill the demand from the lower levels, and you don't want to get trapped. So that's how you can exploit demand or support levels that you might have known as not being valid fake demand levels, or inducements. And for the supplier resistance, the same theory applies just the other way around. I might make another video specifically for that one, because as you've seen, this is not easy at all. It's quite complex, takes a long time to explain, and also takes repetition to understand. In the meantime, if you found this useful and interesting, you might take a look at our program linked in the description of this video. Also leave us feedback in the comments, and see you on the next video.